The significance of this module is that it gives solution. The module is operation of allowance for future capital sums, receipts and payment. The significance of this is that it gives solutions to the deferring of capital receipts and payments by capital owners and tenants in the context of the valuation of their interest. What I mean to say is that it helps the valuer to know how to discount these payments, capital receipts and payments in their valuation. So when you are confronted with a valuation like this, where you need to defer capital receipts and payments, you know exactly what to do and how to carry out the deferment. Now, allowance for future capital receipt, we start from there. Sometimes an owner of property is entitled to receive, in addition or in lieu of rent, a capital sum or series of capital sums at a future date or dates. In such cases, the usual practice is to value the property as though no sums were receivable. That is by multiplying the net income and the capital value, and the year's purchase. Then you add the present value of the sum receivable in the future. I hope that you have learned that in the elementary classes. In considering the value of future capital receipt, the valuer must place himself in the position of the purchaser of the property. Actually, the essence of this is that you value the property as though no sums were receivable. Multiply the net income by the year's purchase, and you add the present value of the sums or sum receivable in the future. That is, capital value of the property plus the price of the future receipt. Yeah, there's a worked example here. But before I go to the worked example, note that the value of a future capital receipt is found by multiplying the amount of the sum receivable. If, for example, it's going to receive 5,000 naira in 5 years' time, you have to multiply this 5,000 naira by the present value of 1 naira receivable at the end of the 5 years, because it must elapse before the sum falls due. And you use the remunerative rate calculated at the rate percent at which interest is required on capital. That is at the remunerative rate. Now, if you look at the example, you can easily get what I'm trying to say. Value the freeholder's interest of a shop let at blah 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 blah. And what you have is, first, value the property as if it is normal. Without any expectation of future capital receipt. Then you factor the price of the future capital receipt and defer it, because the question says 3 years. In 3 years, in 3 years time. So you PV it in 3 years and you now add it to the valuation figure, because it's a receipt, because the landlord is receiving it. And is receiving it at remunerative rate. So you apply the remunerative rate, whatever percentage you deem fit, 8, 7, 9, whatever it is, and you add it to it. So you have allowed for a future capital receipt. It's a simple way. So you see the solution. Section A, capital value of net income. How to calculate that? You value it normally, YP 10 years at 6.5. Then reversion, there's a reversion to PV, because it's not, you are valuing the freeholder's interest. Then YP deferred 10 years at 8%, that's 5 point. Check your table, that's 5.8. Then the price of the future capital receipt. The premium, which is 2,500, which the landlord is going to receive in 3 years' time, and PV it and add it to the value. That's 1980. Add it to the value up there, and you get 22,250. So simple. This second example is just the same principle with the first one. The only difference is that the premium that was paid on entry will not be included in your calculation because it has been paid. We are talking about future receipt, so that 5,000 will not be included in your calculation. Of course, you have the lease itself has 52 years to go to run unexpired, so that's what you take into account. So what else? Then 21 years minus 11 years, because it was granted 11 years ago, so you have 10 years to that. Then 63 years minus 11, then you have 52. I mean, you have 42 years minus 11, you have 31. So that accounts for the PV and the YP that you are using. 63 minus 11 years, because it was granted 11 years ago, you now have 52 years unexpired. And the PV, because it's going to be paid in the 42nd year, minus 11 will be 31. That is what is accounting for all the differences there. So you can see the rent reserve is 5,000 naira. YP 52 years at whatever rate you think is appropriate, Then reversion to full rental value. Remember, you are valuing the freeholder's interest. Then YP impaired, because there is a reversion to perpetuity, it's a freeholder, but you have to define for 52 years, which is the unexpired term, at an appropriate rate, which is slightly going to be higher than the first rate up there because of the risk premium. Then the premium to be received, 5,000. You can see the first one is discountenance. You are only using the second one of 21 years, not the one paid on entry. So you have 10 years at 5.5. Then you PV it to 31 years, because 31 years is what will be unexpired. PV has to wait for 31 years to collect that. So at 5.5%, then you multiply all together and you get the total value of the interest. So easy. There is something difficult there. It's very, very easy if you follow what I'm saying. Yeah, we are done with the allowance for future capital receipts. Now we are going to allowance for future expenses. Now the key to this is to value the property as if there are no future expenses to be incurred, and we now determine the value of the future expenditure and deduct from the initial value of the property. That is the key to this section. Now, if a property is in a very bad state of disrepair, what do we do? What we do is to estimate its value as if it is in a proper state of repair, and then deduct from such capital value the estimated cost of putting the building right. That has been our method all along. So future capital receipts or future capital payments, which is an expense to the landlord, what do? We just defer at the remunerative rate or accumulative rate. I will explain that later on. Whichever is required. And once you are able to get the capital payment deferred, we deduct it from the main valuation figure. The decision as to whether the remunerative or accumulative rate depends on whether the future capital payment is an expenditure or a liability. I will explain that as we go by. Now, where evaluation has to be made of property on which the immediate capital expenditure is required, the normal method is the procedure to value the property and deduct the expenditure in question, as I have said before. For instance, if a property is in a very bad state, the usual method will be to estimate the value as if it's in the proper state and then deduct such capital sum. The estimated cost of putting the building right. Sometimes, however, an expenditure may not have to be incurred until sometime in the future. In most of the cases, it's not immediate. It could be immediate, it could be in the future. So if it's in the future, we'll come back to this deferment thing. We have to pivot to today because we are valuing as at today. If it's immediate, you don't have to PV anything because the money is with you real. So you just deduct straight, no deferment. In which case its cost is deferred by multiplying it by the present value. That's if it's a future thing. Future capital payments may be deferred at the remunerative or the capital accumulative rate, as I said before, and the decision depends on whether it's an expenditure or a liability. This is what I'm just repeating myself. Anyway, in the next slide I will explain what an expenditure is and what a liability is. Yes, I would like to distinguish between what an expenditure is and how it differs from a liability. An expenditure could be an immediate expenditure, or it could be a future expense or some future expenses. But what is important is that it must lie in the discretion or at the discretion of the owner. The owner is not under any compulsion to carry out the expenditure. It's not under any compulsion, any agreement, or any lien, or any form of compulsion, I will still say, to carry out the payment. So it's free. He may not. He may do it, he may not do it. So that is why the deferment is usually at the remunerative rate, at the market rate, if you like, because it's not under any compulsion, and in most cases such expenditure will enhance the value of the property. So it is related, the interest expected from such expenditure is related to the market value. So it's not under any compulsion to do it. Then I can give examples of that. Alterations and improvements. He only does improvement that he thinks will enhance the value of the property. It's not under any compulsion to carry out all alterations or all improvements or bear the cost of roads or sewers. So any work to be carried out to the property by a lessee, or by a landlord too, in which he is not required to do by the covenant. There is usually a lease agreement and he is not required to do it, but he thinks within himself that if he does it, to enhance the value of the property. So the applicable rate will be at the remunerative rate, the market rate, the market derived rate, because it's not under any compulsion. Then I go to liability. Liability is a legal or contractual charge. It's under compulsion to do it. The payment is enforceable. If he refuses to do it, it is enforceable at law. So it has become a liability on him, for which he must set aside a sinking fund. It requires the investor to set aside a sinking fund to be able to meet this liability, because it's a must. He must do it, whether he likes it or not. It's compulsory. It's compulsory. So he must do it. So the general rule for deferment, I'll go over it again, of future capital payments may be summarized as follows. Future capital payments, which are expenditure, are deferred at remunerative rates. Then future capital payments, which are liabilities, are deferred at the accumulative rate. Accumulative rate is sinking fund rate, which is like 2.5% or 3%, as the case may be. Now, let me remind you again that capital liabilities should be deferred at the accumulative rate, and I've explained that because the investor will need to set up a sinking fund to be able to meet a capital sum which is compulsory at the end of a certain period, so that he will be able to do it. Otherwise, he goes to court, or he can face other forms of penalties for failing to do it because it's a liability. Now, I give you examples of liability. Payment that leases are obliged to make in fulfillment of covenants in the lease are liabilities. 1. A sum to be spent on dilapidation at the end of a lease. It will have been put there in their lease covenant that a certain sum will be spent maybe after 5 years, after 7 years. This has become a liability to the property owner or even the tenant. It depends on under whose aegis it is falling. Or a premium or fine becoming payable at some future date during the term as an obligation under a lease. Or like public health notices, these are compulsory payments you must make. Nuisance abatement notices and so on. So once again, let me inform that these expenditures are capital expenditures or capital liabilities. Cost of putting a property in a habitable state, which is different from cost of keeping the property in a habitable state. Cost of keeping relates to maintenance costs, repairs, insurance, and all that. Cost of putting is either capital expenditure or capital liability. That's why I've made the distinction very clear. And what we have discussed so far has to do with cost of putting a property in a proper shape to generate an expected income. Either way, either from the point of view of the tenant or the point of view of the landlord. So that must be cleared. It is not maintenance. That's why I've taken the time to give examples of expenditure and liabilities. You can see they are all capital in nature. They are meant to put the property in a habitable state, not to keep the property in a habitable state. Thank you. Work example 3 deals with how to account for deferring expenditure, as we have explained before. So if you read the question, you see that a shop is let on FRI. FRI means full repairing and insuring. This for a rent of 2,500. At the end of that time, if 5,000 is spent, putting in a shop front and otherwise bringing the premise up to date, it should be possible to let that 3,000 value the field as interest. Now, if you look at this, a method of deferring expenditure, and since it's an expenditure, you defer it with the remunerative rate, and you can see the regular valuation YP 8 years. In the reversion to improved rental value, which is 3,000, say 3,005, improved rental value, or 3,000. I think it should be 3,000. Okay. YP, defer it for 8 years, you get 41,000. What is important that is, since it's an expenditure, it must be deducted, and we are using remunerative rate. That's what is important. Then you get a value of say 38,000. I think that the version should be to 3,000, or I can just change to let it at 3,000 instead of 3,500, or I change it to 3,500 so that to conform with the value with the calculation. But what is important now is not really the figures, but getting the principles and the application of the principle. That's what is important. Worked example 4 relates to an example on the deferment of liability. So you can look at the solution. Just value normally net track rental value less 1,000 will give us the profit rent. Capitalize the profit rent for 41 years, which is the unexpired term. But because it's a leaseholder, so we must use the dual rate YP. It's a normal valuation, 7.5 stroke 2.5 or 3, as the case may be. Then less the premium which he has to pay is an expenditure, but premium is a liability. Premium is a liability, so you now defer it, and 0.61, which is 1,002, and capital value will be this. The profit rent is capitalized using a dual rate, which is very important, very, very important. Another point of importance is that the PV is at 2.5%, which is the accumulative rate, not remunerative rate. Remunerative rate will have been 7.5%, but because it's a liability, that's why we are using 2.5% or 3%, as the case may be. Thank you.